Hey, welcome to part 2 of how to use indicator of indicators. So this is part dos, part zwei, part duo, part ni. So we've covered Japanese, Korean, French, German. I am pentilingual with the number 2, which is very impressive. All right. Now, all joking aside. So part 1, we talked about how to set it up. And feel free to go to part 1. I will put a link below this directly to part 1. And that shows you how to set it up on your charts. And by the way, I want to really thank you guys. A lot of you put comments as I requested on how to do it on other trading platforms other than NinjaTrader, which is what I'm using. And a lot of you did. So thank you very much for being so generous in helping other traders. I love that. I really respect that. So today we're going to go into more detail. In fact, I had a lot of emails in response to this video, and so we're gonna have 3 parts to this at least now, as it turns out, because of the questions that came in. So I want to share with you how these things work. That's what we do at TopDogTrading. We specialize in not just saying, okay, here's a setup, here's a setup. We actually specialize in giving you the reason, the logic, the rationale, the intelligence behind why something works and why it will continue to work in the future. And that's what I do with my students. So I'm going to do part of that here today as well, because I had some questions coming in about that. So the MACD, all I'm doing is plotting the MACD line and then the stochastic on it. So I'm actually going to remove the stochastic right now. I'm sorry, stochastic, the Bollinger Bands, and just show the MACD. Now, what we're doing is just showing the MACD line here. And again, for that setup, go to video 1. I'm not going to repeat all of that. It's all there for you. So this is just the MACD line. No signal line, just the MACD line. The MACD line is the difference between the 12 moving average and the 26 period moving average. Now, you'll see 9 here. That's the moving average of the difference between the 12 and the 26, the signal line. We don't use that, not in this example at least. So what we're going to, and we also are not using the histogram or the diff, or the difference. So if you would like to use that, that's fine, but I'm just trying to make things simple for you. Especially when you use indicator of indicators, one of the problems can be that it gets too messy, too much information, and that's why I like to simplify it. Okay, so now, what does this really mean? What does this MACD line really mean? It means the difference between the 26 or the 12 and the 26 moving average. So best way to show this is just to literally show it to you. So let me go down here. There we go. Now you can see it. So if we go in here, all we're going to do is use EMAs. By the way, it's very important. The MACD does use exponential moving averages, not simple moving averages or any other kind. So you can experiment with that if you want to a little bit, but this is the default setting. Okay, so we got the 12 period, we got the exponential awesomeness, and we'll make this the shorter one. I like to use green for shorter and red for longer for some reason. Just use whatever makes sense to you. It's cool. All right, so we'll apply that. And we're applying this to price now. And you don't have to do this, but I just want to, again, explain what the MACD line is actually giving you. And then we put in the 26 moving average. All right, we'll change that one to come to some sort of red here. Oh, there's actual red right there. And yeah, that's it. Okay, so now here we go. So this is what it means. And let's bring up our little crosshairs so we can show you. All right, so when the MACD line goes back to 0, okay, there's 0, that indicates that there is no difference between the 12 exponential and the 26 exponential. Again, you can choose whatever moving averages you want, but these are the standard. So you see when it crosses here, the MACD line crosses 0. That's when the 2 moving averages cross. So, whoops. My mouse is acting kind of crazy today, but that's exactly what it means. So that's the first thing to note. Same thing here. The green line, which is our 12, our red line, which is our 26 exponential moving averages, when they cross, then guess what? MACD crosses the 0 line. Why? Because there's no difference between those moving averages, and that's what it's measuring is the difference. Now, having said that, let's take it to the next level of understanding, and let me take off my crosshairs, otherwise it's going to get a little confusing, a little crazy here. So now, the other thing you need to understand, when it's going down, okay, when the MACD line is going down, that means that the difference between the moving averages is getting wider. So, as you can see here, the width here is less than the width there, or the difference. And that's why this is going down. Now, here it goes up. Why? Because the difference here, for example, just use the extremes, is not as wide. Now, the 12 is still below the 26 exponential moving average. So they haven't crossed yet. Otherwise, the MACD would get to the 0 line. But remember, it's MACD stands for Moving Average Convergence Divergence. So here, they are diverging. They're moving away from each other. The distance is expanding. So that would be the divergence part of it. Convergence is when the distance between the two lines is getting less, and therefore it moves up. So, do not oversimplify this. Do not think that just because the MACD line is moving up, that price action's moving up. That is not what it indicates at all. And remember, it's an indicator. Indicators do not make you money by themselves. Indicators are not a direct line to making profits. Indicators, well, if they were, we wouldn't call them indicators. We'd call them what? We'd call them money makers. And we don't call them money makers. Why? Because they're not money makers. They're indicators. And so the answer's in the question, what's an indicator? It indicates something else. And in this case, it is not indicating that price is going to go up, that the market's going to go up. What do we got here? Apple. It just indicates that the two moving averages are coming closer together. And that's it. It's a mathematical formula. Indicators are technically never wrong. That's kind of the beauty of them because they're just math equations. So these lines, or this line here, that is not really the indicator. What you talking about, Willis? Yeah, that's not the indicator. The indicator is a math equation. And then the math equation plots visibly something on your chart, in this case, a line. But the important thing then is to understand, well, what is that math equation measuring? And this, by the way, is true of every indicator. If you choose to use indicators, and some people do, some people don't, but if you do choose to use indicators in your trading, you better understand what that mathematical equation really is measuring. Because it's not going to be wrong. Math is never wrong. But don't think that it's telling you what the market's going to do. It's literally just telling you, in this case, that the two moving averages are moving closer together. Now, what you make of that, that's the next step, right? But with any indicator, understand that you better understand what that indicator means. Otherwise, you're going to lose money, frankly. And by the way, I would never trade with just one indicator anyway. So we got to include price bars, obviously. Price is king. We have to use risk management, money management, self-management is pinnacle. So you need a whole trading system, right? And this would be just one piece of evidence. One piece of evidence that you'd combine with other things. So, but we need to understand each of those pieces of evidence. So that's what it means, and therefore, if you think, oh, the price bar is going to go up, market's going to go up because MACD is going up, you're woefully mistaken. That's not even what it's meant to measure. Okay, crosses above the 0 line here. Right there. Kablambo. Oh, there's that famous classic technical analysis term, kablambo again. So now what happens? So does this mean that the market's going to go screaming up to the highest heaven, the seventh heaven of the seventh heaven? No, not necessarily. And now look what happens with the MACD line, right? It kind of flattens out here. And that indicates that the two moving averages are really pretty close together. Not a whole heck of a lot happens. In fact, from this high, it just provides resistance there. And that's it. Okay, so again, just because it's above or below 0, doesn't mean a whole heck of a lot. Now, in part 3, we're going to talk about that more in more detail. Right now, I've had some people ask me what MACD means and all that kind of stuff. And that's why I'm addressing this. Number 1 is to answer your questions about that, but also number 2, it's a general, I want to give you the general rationale of indicators, whatever indicators you're using, that you better understand what that math equation is literally measuring, because it won't be wrong, but don't directly associate it with profits. All right, so, it wiggles around a little bit. Why does it wiggle around a little bit? Well, because there's, a little fluctuation between how close these lines get. Now, here we cross, the moving averages cross over, boom, and now it keeps going down. MACD keeps going down. Why? Because the moving averages diverge. They get further and further and further apart, and that's literally all that means. Literally all that means. So again, if we were to say, okay, now the market should go up, it didn't. Right? It pretty much is in just a trading range here. And by the way, this is a real-time chart. I didn't really expect anything to happen here necessarily. I just thought it'd be fun to show a live chart. But we'll do some other stuff with that in the future. Right now, it's just to explain the logic, the rationale, and the mathematics of the indicator. So in the next video, in part 3, we will get into, okay, so now that we understand all of this stuff and we understand what it literally means, now we're going to put the Bollinger Bands back on the MACD and show you some more intricate stuff on how to trade that. So thanks for your questions. By the way, again, if you have any questions, type them into the comments area below. And if you have any feedback or things you can share with others, some insights you have beyond this, that'd be fantastic. I'm not trying to be the rock star here. This is a community effort. And if you can help other people, then let's do it. Let's all help each other here. And by the way, if you're interested, I do also offer one of my trade setups absolutely free. It's called the rubber band trade. And it's that is a full, complete trade. So whereas here I'm just isolating indicators and talking about them one by one, the rubber band trade I offer is a complete trade methodology. So that is actually meant to make money. I give you all the details that you need because I want you guys to make money. So I offer that for free. It's in one of my courses. I haven't pulled it out, but I've just copied it over to share with everybody, even if you're not a paid student and just want to demonstrate to you that I can help you make money. So that's absolutely free. Click on the little I with a circle around it on the top right corner of the video. Or if you don't see that, go into the description below and I have put the link there. So you can just click on that link in the description and you'll be able to go there and get the rubber band trade strategy with my compliments. So thanks everybody. And the next video will probably be coming out, well, probably tomorrow. So I'm trying to crank out more videos faster for you guys, especially when I do a series like this. I like to put them together. So if you liked it, feel free to share, comment below, share the video with others, and I wish you all a great day, and we'll see you tomorrow.